Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Wednesday morning. If it's Wednesday, we know the last trading day of the month shan't be boring. We've got the FOMC at 2 o'clock with the monetary policy, the rate statement, and then the press conference at 2:30. This, of course, is end of month, which brings its own shenanigans, but it should not be anywhere near as volatile as we saw this month's OpEx or even at the end of June, end of quarter. So we're going to be operating with a little bit of, I won't say hesitation, but caution as we're looking at what we'll be dealing with the current earnings, right? We have a lot of earnings this week too. So forget about JOLTS yesterday, FOMC today, and non-farm payroll on Friday. We still have a lot to come by way of earnings. And we got just a handful of them yesterday. First up is Microsoft. And you can see where we're sitting right now. Look, Microsoft, is it doing any favors for the broader averages? We were far lower than we are right now. You can see currently Microsoft is trading about $416. Is this a strong stock having a suddenly weak earning? And that's something I want to mention. This is not a stock that was strong before earnings. In fact, the trend ended in terms of what we had through mid-June to mid-July. The trend ended on July, as you can see there, 18th. And then we started getting red candles, which is not just a bearish candle. It's bearish participation and it's a bearish candle. So you put those two things together, what you end up with is the fact that Microsoft was not strong in front of earnings. And why would I presume earnings should suddenly bring it out of, the basement, if you will? And I think that's where a lot of traders will get caught up in a narrative of earnings where they're looking at price. Remember, price, especially immediately into earnings, is really following what the expectations for revenue and earnings per share are. So take the technicals off the table for a moment. The closer and closer we get to the earnings release, it's just a matter of what is the whisper number, what is that expectation of earnings per share, what is the expectation of revenue, and then what did we get? And it's just that kind of contrast. Same way we'll treat non-farm payroll Friday morning at 8:30. What did we expect? What were the whisper numbers? And what did we get? And then we assign meaning to whatever that chasm is, whether it's better or it's worse. And that's earnings. Now, I'm not going to subject my account to that kind of completely right, completely wrong, vol crush type environment. But I will say, if you go back 1 month, right? Go back 1 month, look at where we were on the 30th of June. Look at where we were on even the 14th, 15th of June. That's your 6 to 4 week window in front of earnings. And take a look at the price action that we saw from here's end of June, here's mid-June. Take a look at what we saw from mid-June, end of June to end of July. We had a nice trend here. So if I'm somehow thinking that playing this binary straight up or straight down or taking advantage of volatility crush is my strategy, it's not for me. Make sure you're also considering what we call the earnings swings. What is that expectation into earnings as those revenue expectations are baked into the cake, as those earnings per share expectations are baked into the cake? Because at some point, the baking's done, right? And now we're just waiting on the result. And that's why we open the window up to earnings 6 weeks before release. And that sweet spot's usually about 4 to 2 weeks out. So if you're struggling with earnings, or if you're saying, Rog, I hear everyone talk about, playing earnings. Is it something I have to do? Oh, gosh, no, right? Earnings are a hot zone, much like non-farm or anything else. It's a scheduled high impact event. That's why I call them hot zones. And when we have an event like that, immediately in front of the event, a lot of times traders say, hey, we've already baked in what our expectations for Amazon were, and now we're just waiting. So we kind of go in that sideways range oftentimes in front of that event. So let's talk about that in front of another event. In this case, taking a look at the intraday charts of, say, the S&P or the Dow or the NASDAQ or the Russell. So here we are looking at today. I'll just push this out to 3 a.m., which is our London Open. And, we might get whatever happens this morning. Things are relatively bullish at the moment on the 5-minute chart of the S&P. Obviously we're 5 hours before the FOMC, but I would anticipate as we get closer and closer to that event, we're going to find a range, because who wants to stick their neck out, right? And I think the same thing you can say, you'll see, not just intraday in front of a FOMC event, but also end of day in front of an earnings event. So what was the better action to play? The ramp up. This is a nearly 24-hour symbol, the S&P. Is it better to play the ramp up into the U.S. Open? Perhaps. I mean, that's right there. You can see that's, an 85 point move from the Asian session into the pre-market U.S. So where are we likely to see most of the movement? And keep those things in mind as we're looking at levels to watch on the S&P. By the way, keep an eye on 55.15. Keep an eye on 55.25, and also keep an eye on 55.42 or 55.43. We have some volume ledges in that area. Maybe a fourth level to keep in mind, about 55.34.5. One of the things that I've been really talking a lot about has been focusing on where the strength, where the action has been versus where it is now. Past tense versus present. And past tense is S&P and NAS. Present is Dow and Russell. And that is the way it's been for a while. After this week's earnings, we might see a little bit more clarity in the NASDAQ once we get a bulk of the Magnificent Seven earnings out of the way by the end of the week. And we'll also have the non-farm payroll by the end of the week. And we might get some clarity into that first full week of August in terms of, what's next for the S&P and the NAS. Are they going to still lag behind Dow and Russell, or are they going to start to join? And we'll see broader participation across all four indices. Don't know, right? No prediction here. We'll just wait for certain events to occur. We'll wait for them to be digested, and we'll then get some clarity after. But the clarity we have right now is strength in financials, strength in regional banks, strength in healthcare, strength in Dow, strength in Russell. Does that mean every day is going to be up? Oh gosh, no. Right. Remember, if I'm looking at a daily time frame, I'm looking at days to weeks. If I'm looking at a 5-minute time frame, I'm looking at today, right? Day trading is today trading. So I'm not saying every day will be up. No, but what I'm saying is the general gist. If I step back and look at price action over the course of a week to maybe 10 days, my expectation would be for higher highs and higher lows. All right, got a couple questions coming in, and my thoughts on GE for a swing. Sure. So GE is an interesting look at the industrials, and there's not a lot right now that has a ton of clarity. But I'll tell you, let me tell you what we've got going on as far as our watch list in the sector secrets mastery. So just the other day, we built out a watch list, and the watch list for XLI, Eddie, right now is CAT, GE, RTX, LMT, ADP, and UNP. So these are the relative outperformers, if you will, within that overall group. I do like GE. It's got the green candles. It's clearly above the equator way down there at basically 130. I would want to pull back buy. And ultimately, whether that pullback buy is going to be an oversold buy from perhaps the point of control, whether it be a Darvis level like 158 or 153.35, that area, that's really going to be up to the individual indicators that I use to determine where is a market oversold. So if you're wondering, okay, Rag, what is an indicator that I could use if I've got multiple support levels within a chop? How would I make that decision? And the best way to make that decision, I have found, is either we use two indicators, a slow stochastic, or we have something we call the sector secret squiggle, which is in many ways visually very much like a slow stochastic that also factors in participation. But here's the setting for the slow stochastic to use. And I've used this for over 25 years. It's a 21K 3D, set at 80 and 20. Very, very little in terms of free indicators, and even most paid indicators whose jobs it is to find overbought and oversold will outperform that. And my secret squiggle is just a variation of those settings. And they just work. You're right. They just work. So ultimately, what I want to keep in mind is that if I have multiple levels, so for example here, GE, moving in a chop, it's my job to, one, recognize the top and bottom of the chop. And sometimes it may not be one ceiling and one floor. It might be multiple ceilings and floors. So then when I've got to determine which one I want to do, well, I want to be a buyer. That's pretty much what I'd prefer to be. So I'm not really looking at overbought puts or overbought shorts, right? I'm looking for oversold buys. And then what I want to do is wait for that indicator, in this case, a slow stow, to confirm that we're at a level where I would expect to see some flow come in. What is flow? Flow is buying. Flow is support. A floor is demand, that flow of buying. And that's what I'll do with something like GE. All right. Okay. Next up is, let's see. The charts are beautiful. I appreciate that. I think they're pretty darn gorgeous too. I think they work for all markets. My opinion is, look, it's going to be my opinion, right? I don't want to say anything in absolutes, my friend. My experience has been, as long as you focus on liquid markets, not meme stocks with very little liquidity, or futures contracts with very little liquidity, or ETFs that simply don't have more than 10,000 shares trading a day. There are plenty of those. As long as you focus on liquidity, things like price, volume, time, volatility will work on anything. And that's really where the clarity for me comes from. Remember, there are 4 factors that move a market, and most traders focus on price and price alone. Some will look at price and volume, but usually they're looking at time-based volume, date-based volume, not price-based volume. I like to use price-based volume. Very few have ability to look at volatility, historical volatility. And lastly, time, whether that be time of day for a day trader, whether that be different periods in the month where we have different high impact events. So price, volume, volatility, time, you put all that together, that's pretty much what I've got running on my charts. I appreciate that. Okay, next up, let's go ahead and do this. I just started up my Thinkorswim platform. It was taking forever to start this morning. And I'm going to take you on over to a couple things here. And I'll show you all the multi-charts here, because we've been spending a lot of time in the mastery looking at this layout, which is multiple charts. Yes, it's a lot of charts, Rog. It is. But what we're trying to do here with this is to me, this is the kind of scanning that matters. Most scanning is finding disparate symbols. By that, I mean symbols that have no correlation to each other, no reason to really be compared to each other, and then find some technical criteria that they agree upon. That's what most scanners do. Nothing wrong with that. I think a lot of traders still use that style of scanner. There's another style of scanning, which is still going to use some kind of technical indicator. Obviously, I've got a ton running here, but it's going to compare stocks that have a correlation to each other, have a relationship to each other, tend to be affected by each other. And that's where we are in modern markets because of high concentration weighting. And what that should remind us is, when Microsoft has earnings, let's jump on over to XLK. It's not just Microsoft that's going to potentially experience a volatility event. It's a number of other stocks as well that are going to be affected by Microsoft's weighting, whether that's in the NASDAQ, the S&P, the Dow, or the XLK. Now, Microsoft's weighting in all 4 of those groups is different. The more the weighting, the more the influence. In this case, XLK would likely have the most influence from Microsoft. So if Microsoft is dragging the XLK down, all the stocks within it are having to fight off that weakness, right? So keep in mind, earnings season is very much, I like to call it tail wags the dog season, where a single stock can have a broader impact on the index or on the sector in this case, right? So we have a question here in terms of Disney. Sure. So, well, actually, let's do the same thing with Disney for a moment. So Disney is in the XLC, and it's actually been a very weak part of the XLC. XLC has not been very strong. In fact, the strength in XLC has been coming from where it overlaps with telecommunications. So you have your communications stocks in this XLC sector, but then you have the overlap of the telecommunications. And that's generally been the stronger part of this group. Think think Verizon, think T-Mobile, some of the stocks that have been generally stronger. Charter continues to be strong, but Netflix, Disney, they're actually the weakest names in XLC. So if I step back and if I'm thinking about some sort of a longer term equity position, I don't have a setup here really on Disney. I'm not really interested in the long side of Disney. I don't know what's going on within Disney. I really, frankly, don't care, in terms of, what's on the pipeline in certain movies and whatever's happening. Here's what I can say. Little of it is good, right? Little of it's resonating with underlying revenue, clearly, and investor interest. So I know I never can be alone in a trade. If a trade's going to win, if an investment's going to win, remember, we can't ever be alone in that idea. Now, we have celebrated, and this is probably the worst thing to come out of one of my all-time fun favorite trading movies, which is The Big Short. The worst thing to come out of that is this notion of the hero trade, right? To be the first one to stick your flag in there and say, I was here first. I'm the one that saw the idea, and just hang on, right? That's actually been now a catalyst. Fast forward since the movie and since the book really. Traders saying, well, I'm the first one to say, here's the top. I'm the first one to say, here's the bottom. I'm the first one to make that call. And it's a really scary thing that's now been normalized in trading and investing. In fact, we celebrate that stuff. Oh, so-and-so called the bottom. Who cares? And then they name it some special bottom, right? Anyway, I want a bottom named after me. That's pretty funny. So the idea of remembering that, yeah, Disney might bounce and Disney might make lower lows, or it might rally from here, but that's okay. We want to wait until the volume and the participation starts to show that, you and I aren't the only ones thinking Disney's at a floor, right? And this is also what's happening in things like the NASDAQ, where folks just want to call the bottom. I don't know where the bottom is. And guess what? Neither do the folks who are calling it. We can only find patterns and probabilities. And if you want to know how I do it with patterns and probabilities, not forecasting things humans could not possibly forecast, is the pattern of a minor low. And I explain it in detail in yesterday's free video over at the Simpler Trading YouTube channel. So if you want to check out why I don't care if there's a bottom in the NASDAQ or not, and this is definitely not the week to sort that out, and why the S&P might be the place to talk about that, check out the video. I walk you through candle by candle how much of the sell-off got our attention, what price was hit, down to, I think, the proximity of a few points, and then what pattern do we look at to form and then break out to confirm that bottoming process is happening. So check that out, and I'll see you tomorrow. Same time, same station. Again, gang, FOMC at 2 p.m. today, press conference at 2:30. We are heading towards September 18 cuts, but July is expected to be a hold. All right, gang, be good to each other.